Thank you for tuning into the All Funds Investment Podcast. This conversation is with Sean Campbell, Managing Director and Head of Distribution for Valiant's family of alternative strategies. Sean takes us through how litigation finance and tort cases work and how these products are structured. We'll get into what it means today, but Mass Tort refers to class action lawsuits. And just a reminder here that nothing said is legal, tax, or investment advice. Check out the full disclaimer below. We hope you enjoy this conversation. Please like and subscribe if you find this information helpful, and check out the links in the description to connect with us and Sean.
Can you provide a brief overview of just litigation finance as a whole, and we'll kind of get into some of your background as well. But yeah, you want to start with that?
Yeah, absolutely, Skylar. I think it's important to walk through two histories when it comes to this. We'll walk through the litigation finance history, which is a little bit longer than the mass tort industry. So the way that I explain it is, think of it this way. Litigation finance touches every aspect of law, but not every aspect of law is mass tort, if that makes sense. Litigation finance itself has been around for a minute. It dates all the way back from what history can tell to 1200 AD. Wow. Back then was the first recorded where you had a bunch of wealthy people that got together and said, hey, look, those guys over there, they were wrong. Let's fund them as litigants, and then we'll share in the profits. But if you fast forward to modern times, or turn of the century, 19th century, or 20th century rather, 1906, that was the first time where litigation finance really started to hit the U.S. And from a litigation finance standpoint, as you can imagine, it's finance. It was typically banks. So think of a law firm, and I'll use an example that's going on today. If I'm a law firm that is going to fight a big corporation, like let's say Johnson & Johnson, which is in the news today for talc baby powder. If I'm one law firm and I go to fight Johnson & Johnson, Johnson & Johnson will turn around and be like, that's great. We'll see you in court, because they're going to bury me. I don't have the assets. I don't have the resources that I need to fight them. And the law firms knew this right off the get-go. So they did two things. One, they joined together, but that still wasn't enough. Two, they said, okay, where do we go get some money? So they would go right to the banks and they'd say, hey, I need $25 million. And I want to go fight Johnson & Johnson, because it costs money to litigate. You need expert witnesses. You need to go through investigation, discovery, all of that. The bank in this aspect would turn around and say, okay, we're going to treat you as a business. This is a loan. Here's your $25 million. Here's your monthly payments. The interest we're charging. Don't miss a monthly payment. The minute that happened, the bank released the funds over to the law firm. The law firm had a chunk of money and can go fight Johnson & Johnson. Skylar and Mike, as we know, when asset classes start to evolve, that's where innovation steps in. And there was this asset, well, I don't want to call it an asset class, a manager or a group of people that stepped in back in about the 90s and said, wait a minute, this looks like it's a really lucrative business. And that was the hedge funds. So hedge funds stepped in and went to the law firm and said, we can loan you the money. You want the money? I've got $25 million, because what are hedge funds doing? All they're doing is trying to find these asset classes that are going to help bulletproof and diversify out from the traditional capital markets. If you fast forward to recent memory, the only thing that's changed is litigation finance firms have entered the fray. And what I mean by that is specific firms that will focus on one thing. Let me give you an example. There's a litigation finance firm out there that will solely loan money to law firms that are going out to fight Medicare. They know the Medicare industry extremely well. They're comfortable with that, and they know that, hey, they're loaning money. There's a chance that maybe they lose. Let's make sure we're loaning to an asset class or to an industry in this standpoint that we know very well. After the litigation finance companies stepped into the fray, folks like us were able to come in and create even more innovation and say, okay, there's a way that we can actually get access to the litigation finance world for accredited investors, the general public, because that didn't exist before. It was just the hedge funds, and it was just the actual banks that had full control, full access over the litigation finance side.
Yeah, that's really interesting. So from like a due diligence process, I mean, maybe backing up, just kind of talking about your firm and kind of, is there a specific sector of focus, and kind of just how does that look for you guys?
Great question, Skylar. Thank you. So that goes to the next side of it, is where does mass tort intersect with litigation finance? So brief history on mass tort real quick. I was a history major in college. I'm just a sucker for history. So 1906 was the first recorded mass tort case in America, 1906. And do you know who it was against? It was against a little company called American Tobacco.
Wow.
Back in 1906, people got together and said, these things that we're smoking, they may be harmful to our health. Who knew? Who knew? And then you fast forward all the way to today. We all know it, Surgeon General everywhere. But all the way back in 1906 was the first recorded mass tort case in America, and it was against American tobacco. So if you follow the evolution of mass tort, and I'll use these two terms in congruence with one another, mass tort or class action, some people call them as well, you'll notice that you get to the 70s, and asbestos became a big deal. Today, I'm getting a little older, so typically at the end of the night, my wife and I will sit down like a lot of Americans, and we'll either turn on Pat Sajak or Jeopardy, depending on where you live, is when it comes on. I can guarantee you anybody that's listening to us is going to chuckle at this because they have seen a commercial that says, have you been affected by mesothelioma? Have you or someone been affected by Call us at 800. We'll get the justice you deserve. It's still going on today. As society has evolved, we've innovated. So with that has come new products. New products, unfortunately, at times have negative byproducts that come of it that we didn't know existed beforehand. Gosh, environmental disasters as well are mass torts. Think of the Exxon Valdez. Those happen. And of course, pharmaceuticals. Even going through all of these trials, there are still negative effects. So with that, the mass tort industry has evolved. I mean, I was looking at an article that came out in November of last year because a typical question I got is, how many class action lawsuits are there going on at any one time? Last year, there was an article that came out. It said, here are the top 18 mass tort cases that you need to watch in 2023. There's a lot of them. The other question gets asked to me is, when will this ever go away? Well, the minute Americans stop suing is the minute that we won't have any mass tort anymore. But I share all of that with you because there's an intersection of litigation finance and mass tort where Valiant, where my firm sits, which is important to understand because as I told you, there's plenty of litigation finance companies out there. We're one of them. We focus directly on the mass tort cases, and I'll explain exactly what I mean by this next term in a little bit, but we focus on the late stage litigation finance mass torts that are out there. Does that help, Skylar?
That's interesting. Yeah, absolutely. That's great. I guess just from that perspective, and we can maybe go on a few different ways here, but from your, obviously the late stage side of things, what does the life cycle typically look like, right?
Yeah, very, very good question. We all know you talk class action lawsuit and people say, am I going to be alive by the time this thing closes out? Yeah. There's no real average timetable to when a class action lawsuit will close. On average, I'll ballpark it. I'll say some of them can last 5 years, some can be 7, some can be 9 years. It all depends on how strong the case is, how long it takes to get through. So what we at Valiant did was, again, innovative, because as the asset class expands, you want to find different niches that you're good at, but you also want to make sure that you are keeping your clients focused first and foremost and catering to a specific clientele. What do I mean by that? Think of what I've said before. If I'm a litigation finance manager focusing just on Medicare, I don't mind loaning the money out and knowing it's going to take 9 years. I'm a company that has 9 years to wait. I'm a bank. I have the ability to wait that long. When we entered the fray and said, wait a minute, this can be an investment for the general public as well, we said two things had to happen. One, obviously put our clients' first interest in mind. But two, my gosh, 5 years sounds like an eternity. So that's the exact reason why we focused specifically on mass tort law that was in the late stage game. And I'll share the stages. There's 6 stages of a mass tort case, all the way down from investigation, which is the very beginning, all the way up to the 6th stage in judgment. Everywhere in between is the discovery phase, the trials, and then you get this thing called post-bellwether. Most folks will say, what in the world is post-bellwether? The way that we like to describe it in our industry is post-bellwether is when a judge will come out. You've got the plaintiff and defendant, and they've been fighting for, let's say, the last 5 years. And the judge comes out, doesn't award anything, but turns around and says, I see validity in what these expert witnesses are saying. I'll use Johnson & Johnson, for example. There have been expert witnesses on stand that have basically told the court, talc, baby powder, has caused ovarian cancer for certain females. The judge has ruled and said, I do see absolute validity to that. What has that judge done? He's basically told the courts, the plaintiff and defendant, we're going to take what these expert witnesses are saying as fact. And also in post-bellwether, as much as you've got the mass tort case going on, there can be individual cases going on at the exact same time that may be a little farther along that are suing on their own instead of being part of the class action lawsuit. So let's say a woman decides to sue Johnson & Johnson and the courts decide in her favor and say, we're going to award you $1 million. That immediately moves that mass tort to the post-bellwether phase, which is late stage litigation finance. For us at Valiant, what that means for us is, okay, we've got as much information as we're possibly going to get. We know what's going to happen here. We know that the plaintiff in this instance is going to win. What we don't know is what is the award going to be. But typically, what we do know is time frame. To my point before where we were talking, no client wants to lock their money up for 5 years. We completely understand that. I don't want to lock my money up for 5 years. So specifically when it comes to Valiant, again, we are one litigation finance company, but we've designed the product to be 24-month notes with a possible 12-month extension if the court case goes longer. We felt that that was really the sweet spot for what our clients were looking for an alternative fixed income. I came from that fixed income side of things, and we all lived through 2022. And I know we had a 30-year bull market in bonds where anytime a client looked at a statement, their bond funds were up. It was just the way it was. So at least, Skylar, at least for your and my entire career, I started in 1999. And bond funds, for the most part, never went down. We're in a different age now. We saw that in 2022. We see now that there's obviously volatility could be instituted in. We noticed and said, we feel clients will be looking for something that's a fixed income alternative that can not replace fixed income or bonds, but actually complement it and get those types of returns that they're looking for. Does that make sense?
Absolutely.
Yeah, it does. And in terms of, not specific to your company, but what do spreads typically look like as compared to
Good
treasuries,
question.
maybe?
Very good question. So the way that we always look at this industry, I love being able to try to equate this to the capital markets because it's the place that I lived for my 90% of my career. So there's a couple different specific things. From a litigation finance standpoint, spreads are typically whatever the Fed funds rate is, whatever I can charge for a senior loan, let's say. That's a secured loan because I'm writing against attorney fees. So I always like to put this in more of the market of, let's call it as a litigation finance company, if I'm able to charge 15% to my client, maybe I'm able to pass along 12% at a bottom line or whatever that may be. That's a typical litigation finance company. Where, and I don't mean to change the dynamic here and talk specifically about us, but I think it's important to know that not only us, there's other companies out there that have changed the game on this and actually decided to say, hey, wait a minute, let's help the underrepresented, the people that were actually affected by this. So instead of just giving money to a law firm and letting them fight, let's go find those clients, those people, those Americans that were affected by Johnson & Johnson. Let's go represent them. Let's go help them get the justice they deserve. Oh, by the way, we all know the law industry is quite lucrative. So the lawyers are going to take their fee on that. I mean, I love watching these commercials on TV that we've all seen again, and it's a personal injury lawyer. We're not going to take a dime until you get paid. And then they take 40% of your total damages. Right. It's the nature of how the law industry works from that standpoint, from personal injury. Mass tort's a little bit different than that. But I always look at spreads on whatever you can charge the law firm on a going rate for that loan, because that's what it is. It's a loan, is what you're basically able to get back in return minus your operation costs and all that for a client.
Yeah, that makes sense. And I guess minus the payouts to the individuals within the case.
Exactly, yes. We look at it as we are fronting and helping those clients. But the other thing to remember is from a law firm perspective to a litigation finance company, there is it's illegal, first of all, but a law firm cannot share their award or their fees with another company or anything like that. So there is that Chinese wall that sits there like, hey, I'm the bank, I'm giving you money. But the law firm is out there representing, doing their job. Client gets their part. Law firm gets their part minus what they owe to us for us financing their deal, financing their fight against whomever the company might be.
Yeah, it's really interesting listening to you talk about it because it's when you talk about late rounds, it's almost like a VC fund.
Yeah.
Where you just need you need that extra capital before you go public or whatever.
It's a great analogy. It's a great analogy. Absolutely. Yeah.
How do you go about sourcing deals and the due diligence side to make sure that, this is the right deal that you think you can profit from?
Good question. And this is the truth. I'll talk specifically about our experiences here at Valiant. So remember I alluded as a joke about, have you been affected by mesothelioma? Call this 800 number now. There are marketing companies out there that the three of us know, but quite frankly, if you're not in our industry, you don't know what they are. These 800 numbers are what's called a marketing firm. So when we're a finance company, like a litigation finance company like we are, and let's say I get $10 million in, I want to go source and fund the correct mass tort. The first thing I'll do is this. Let's say there's 12 mass tort cases going on in America today. I will omit 6 of them. And the reason why I'll omit 6 of them is because 6 of them are nowhere near the late stage side of things. So about 50% of them, let's say, are in that late stage side. That's my universe to work from. However, what I want to do is I want to make sure I'm picking the correct one with the shortest period of time and obviously a closing in favor of the plaintiff. That's where these marketing companies come into play. What a law firm will do is they'll say, hey, I got a pile of money and I'm the finding law firm. I want to be able to go out and represent 1,000 females that were affected by Johnson & Johnson ovarian cancer. They don't necessarily go out and find them themselves. They go hire a marketing firm. And the reason they do is all of those people calling into the 800 number, that marketing company becomes a filter. So they call in and they say, yes, I have cancer. I got affected. I had ovarian cancer. The marketing company is saying, tell me more. Explain, can I see your medical records? So they're filtering because they look at, and I hate saying this, but it's the truth. They look at that person as an asset. Now, once they've qualified that person, they can then sell that off to said law firm. Hey, Mrs. Smith got ovarian cancer. Here's the medical records to prove. This is what the doctor said. Sign the contract with XYZ law firm. They're going to represent you in this Johnson & Johnson case. But there's an interesting thing that happens, as you can imagine. If there's 6 cases going on at any time, these marketing firms are collecting all that data, real-time data. So I'll use a prime example. Camp Lejeune. Have you seen the commercials for, did you live in Camp Lejeune during 1994? Call us and we'll get the justice you deserve.
Yeah.
So the first part, when Camp Lejeune came out, who is the actual defendant there? It's the government. It's the absolute government. So interestingly enough, most lawyers said, oh, this is going to be great. It's the government. They're not going to want the press, and they're going to want to close this quickly with a big dollar amount because they affected their military. So while the marketing firms are gathering the data of the folks that were affected and lived at Camp Lejeune and the families that lived at Camp Lejeune, the government actually came out and said to the attorneys, by the way, you guys may think this is going to close soon. No, we'll let it go as long as we can. And you know how much exorbitant fees lawyers make? That everybody's just sick of you guys making so much money? Yeah, we're not going to let you charge those fees either. We're the government. So as you can imagine, think of that as a stock. Camp Lejeune's a stock. Wow, is that a sell if I've ever heard one? 1, it's going to go too long. 2, the attorneys aren't going to make as much money as they thought. But most importantly, back to number 1, it's going to go really long. So we get that, or the law firms get that marketing data, get that real boots on the ground info when they call these marketing firms. And everybody is talking from a law side of things saying, okay, where are we at in the Johnson & Johnson case? I'm sure you guys had heard with Johnson & Johnson, they had tried to come out and actually make a shell company and bankrupt that shell company to get away from this. So the judge came out almost immediately and ruled, said, no, we're not going to let you do that. So obviously then all of a sudden Johnson & Johnson becomes a buy because it's getting closer to the end of that. Because remember, the minute that gavel hits in favor on a mass tort case is the minute no more clients are allowed in there. So that's kind of how you source, and you need a good network, obviously. You need to know these marketing firms. We personally deal with 3 different marketing firms because we want all of that information coming in. So when we're sourcing, we're getting real-time data to know exactly where we want to put our clients' money to work.
Yeah, that makes sense. There's a lot of different scenarios, and obviously things can change and fluid, happen quickly, right? Make
Absolutely.
Sure most up-to-date real-time information as things happen throughout the case. A couple of questions as I think about this. Number 1, what's the portfolio look like? How many different opportunities, shall you say, from the fund perspective that you're looking at on a daily basis?
Yeah, great question, Skylar. So the specific portfolio that we run, ironically enough, There's nothing in there. Let me explain that. This is a secured note. Now I'll talk specifically about us. Obviously, I can't talk about another litigation finance firm. I don't know what they're in. But the way that we've structured this for our clients is, remember, we talked about we want an alternative fixed income. How do we do that? Okay, well, let's put together a secured note. Let's structure it like a CD, because as the two of you know, I need to accrue that interest because the court case hasn't closed yet. If I turn around and tell a client that I can give them current income, what am I doing? I'm just handing their money back. Our clients don't want that. Our clients want their money to go to work. So with us, the way that we do it is essentially, let's say, for instance, I'm talking to a private equity fund that they're thinking about putting this into a sleeve of their overall fund of funds portfolio. They come to me with $10 million. I will source that $10 million immediately and open and close that note the same day. So it's really the client's discretion. We prefer that they rely on our expertise. But if a client comes to us and says, I have $1 million and I hate Johnson & Johnson, I want to be a part of that Mass Tort case, we will source it for them. We will get Johnson & Johnson. We will close that note the same day that we opened it and have a 24-month time horizon at 15% a year for that client. So it's a moving target from a standpoint of how this deal is structured. Each secured note we have is a $50 million note. However, we'll run note 2 with a different QSIP once we close that $50 million. But it's important to note, at least in our structure, that when a client invests with us, whether it's an institution or an individual client, their note opens and closes that day that they give us the money. They don't have to wait for us to go raise $50 million and then the shot clock starts after that. It starts that day. So a little bit of a weird answer to say, hey, we've got nothing in there currently. We do that on specific. Do we have clients right now that are in? Yes, we absolutely do. And they are actually tied. Our clients would see exactly what court case they're tied to. They would also see how many clients are actually underneath that secured note, if you will. And it will actually show them exactly how much they're secured. We shoot for 1.5, 1.5 times to secure that note. Typically, it's somewhere right in that area, 1.5. The one I was looking at this morning was 1.54. So we're always trying to secure that right at 1.5 times.
That's interesting. I guess just you kind of led into my second question, which was the type of investors. You mentioned other funds. Is there kind of a trend on the investor type that you see come into that opportunity?
Yeah, Skyler. So good point. So as the asset classes evolved, we alluded to it earlier, hedge funds and banks. That was it. They were the only game in town, hedge funds, banks. And then all of a sudden, litigation finance companies step in. And now we finally have access for accredited investors, for the general public to be able to access this as part of their portfolio. It didn't exist more than a couple of years ago as the ability for a person, a qualified person, even, if you're talking net worth of over 2 million, those people. But now we're down to that accredited side of things where you're talking about much smaller investments. The initial investment for us at least is $50,000. So it really opens us up to the general public from an accredited standpoint where, we're typically talking to RIAs and their clients about diversifying out their portfolios with stuff like this. Everybody, after 2022, everybody looks and says, what can I do that's a little bit more predictable? Because all of a sudden, my client's statement from fixed income is doing this. I needed to get a little bit closer to that again.
Yeah, maybe a lower duration product could also help on that front.
Absolutely.
From a risk perspective, so you're saying these are, each of these funds are structured to support one single lawsuit. So are there scenarios where sometimes maybe the lawsuit wouldn't work out, and kind of from a risk perspective, how does that look?
Yeah, great question, Mike. Let me reiterate or go back for a second. It doesn't have to be just one court case. So, for instance, when we deal with institutions, if they come into us with $20 million, they may say, hey, I want this diversified. I want 3 different Mass Tort cases, and we can do that. Absolutely. But to your point, let's say I'm picking one court case and that one court case ends up losing. That is terrible, obviously, because then our client is losing money. Remember, we're talking about 15% a year in a relatively safe investment. So let me tell you why we did post-bellwether. Because remember that little idea of the judge has come out and said expert witnesses. We have yet, I'm not saying that it's not out there. I'm still doing my research on it. We have yet to find a post-bellwether case that has not ruled in favor of the plaintiff. Can it happen? 100%. Absolutely could. The judge just turns around and has a a change of heart and says, no, we're ruling in favor of the defendant. If that happens, you are absolutely right, Mike. It's game over from that side of things because there are no awards. With a little bit of return comes a little bit more risk is the way I always like to look at it. This is calculated risk as far as I'm concerned. Remember, I go back to my days of Ginnie Mae's and all that, where I want to see predictability and probability. I know I can't predict. I'm not a weatherman. They get it wrong as well. But I want to see what the most probable outcome is. And we think that we found that sweet spot for the measure of risk. You're getting a decent rate of return above and beyond whatever the risk-free rate may be with Ginnie Mae's, treasuries, whatever that case may be. So at 15% a year, there is some risk. Absolutely. We could get it wrong. I've yet to find one of those that are post-bellwether, though, that it's actually ruled in favor of the defendant. That's our big risk mitigator. When we separate ourselves from the rest of the pack out there, we say, this is why we do it this way. It's almost as if I know private equity on the secondaries. When people are buying secondary private equity, there is the ability to go into a Bain Capital or Thoma Bravo and be able to sit there and talk to the manager and say, oh, wow, this ice cream shop is going public next month. It sounds like insider information. It's not, because you're talking about the private equity market, but that gives that person that's getting ready to buy that security a little bit more added value, saying, oh, this is going public in 2 months, whatever the number is. That gives me a little bit more comfort that this is going up. It's almost like we're trying to omit as much of the predictability as we can by staying in that late stage game and really focusing on the ones that we think are going to win.
That's interesting. This is kind of an interesting market here. A couple questions that come to mind. One is, from obviously everybody gets a current yield over time, a return stream here. Is there any situation where there's like a secondary market where, say, you're 5 to 7 years in with that note and they can again sell that to another fund or another platform?
You guys are asking the right question. So as it stands with us specifically today, there is no secondary market. We are actively in talks because there is a secondary market when you talk about the individual clients. And what I mean by that is, let's say XYZ law firm goes out and buys 1,000 Johnson & Johnson clients from the marketing firm. They sign the contract, so now they're representing those 1,000 clients. They paid a certain amount. In this instance, we'll just use Apple Math and say they paid $500 to the marketing firm for every single person they brought in. So now we go along, to your point, Skylar, 3 years from now, and people are saying, my gosh, I don't want to wait anymore for my money to come in. This is going longer than I anticipated. Well, that person that you're representing is literally like an asset, because as you get closer to the end of the court case, the charge to be able to charge another law firm to take on that client could obviously be more than $500. So yes, from a standpoint for us, for the public, we're trying to create a secondary market for the product itself. But yes, there is a secondary market for the lawyers out there that are looking to try to capitalize and say, I bought these clients for $500. Now I think they're worth this. Other ABC firm's willing to pay $1,000 a client. I'll take that and let ABC represent it the following rest of the way in this case.
Yeah, definitely an interesting concept there, and obviously there's talks of like tokenization in the space, right, and how that play into these types of assets across various situations and verticals. But yeah, definitely a interesting concept as you kind of navigate this space for sure.
From a perspective of like investor types, what type of investors are typically interested in making these investments? Is it high net worth individuals, pensions, kind of all the above?
Yeah, very good point. All of the above. I will say that I'm now seeing more of an appetite on the private equity side of things, ironically enough, as well as the individual investors. I'll tackle individual investors first. I think the reason for individual investors is, quite frankly, it's a new asset class. It's a new idea. It's cutting edge. It's innovative. And it's, oh, by the way, zero correlation to the market. There's no mark to market. So a client gets to see their statement every month and they see it go up by a little over 1% based on the fact that you're accruing 15% a year. And clients like to see that. They understand that they don't have access to that. It's almost like a CD. They have access to it 24 months from now. But that's what I'm seeing from a general public perspective. So a lot of RIAs that are taking a hard look at this and saying, this is a great way to round out and give my portfolio a little bit more defense and a little less correlation. As a sales guy in the past, I remember we would always talk to advisors and we'd say, my XYZ bond fund is not correlated to the market. Look at this. It's very low correlation. And then volatility hits and everything's correlated to one. So I think advisors are catching on to that and saying, okay, I need something that's not correlated when there is volatility as well, because I don't want everything correlated to one and everything going down at the same time just because volatility is introduced to the market. The other side of it, Mike, is the private equity funds now, those fund of funds that are out there that are really becoming, gangbusters, if you will. I don't know a better adjective for it with a lot of the public. You've got a lot of these funds out there that are now marking to market on a monthly basis instead of quarterly. You've got some of these that are interval funds that are able to have clients get in and then get out in a quarter. So with that, they are desperately seeking for new innovative ways to be able to diversify their portfolios out. So a lot of private equity funds will look at this and say 24-month hold. I like that. There's private equity funds currently right now that have done a ton of litigation finance in the past. And when we've talked to them, their big thing was, love the asset class because there was low correlation. However, we weren't all that keen on holding this for 5 years. Wow, wouldn't you know? Institutions don't like holding their money out for that long as well. So we talked about it at the very beginning. With asset class evolution comes innovation. So companies like us are stepping in and saying, we can solve that problem. We can shorten that time period for you.
Yeah.
Yeah. That's great. Yeah. I mean, everybody loves liquidity. I mean, what is there ever any ethical, considerations that come into play when it comes to litigation finance?
Yeah. It's a very good question. The short answer to it is yes. And what I mean by that is if I put on my philanthropic hat for a second and we talk about the real cases instead of it being looked at as an asset, we talk about it in the human capacity. Let's talk about Johnson & Johnson for a second. If you think back to Johnson & Johnson when they put out baby powder, they didn't know, obviously, but it was looked at as this is a way of life. And you're going to use this throughout your entire time from a young female all the way through. And wouldn't you know, holy Moses, later on we find out that this specifically affected lives tremendously, to the point of death in some cases, shattering families, shattering the family dynamic of being able to sometimes even make a living after they got ovarian cancer because of the chemo and they're very weak. So with that, from a standpoint of litigation finance companies as a whole, we feel that we're stepping into a space to help that underrepresented group as well. The marketing companies are doing the same thing. As hokey as it sounds to go turn on Pat Sajak and say, have you been affected by this, call it this 800 number, it's effective because a lot of folks don't really understand and they don't have those contacts on the law side to say, you know what, I think I want to sue Johnson & Johnson. And they see that commercial and they're like, maybe I should call. Yes, I know I've been unemployed for the last 5 years because of this chemo, but maybe I was affected by that. We're helping those underrepresented for certain.
Great way to look at it. Because, you might not even know. I was using that baby powder and who would have thought?
Yeah, who would have thought?
Yeah, that's, I guess, curious too, is from talking to investors, obviously different types of investors you're speaking with. Obviously, it's a very much an education process initially about litigation finance, your specific area of focus, right? How has that evolved over time? Maybe in the last couple of years, things that you've learned, changes in your specific area or niche. What's happened there?
Yeah, very good question. It's moving very quickly. And to my point, 2 years ago, this didn't exist. The ability to access for the general public didn't exist. We're on the cutting edge and the forefront of seeing this. I mean, I'll share this with you and anybody can go look at this. 60 Minutes did a piece on litigation. They called it litigation funding, which focused on a specific company out in California that does litigation financing that helps out smaller people that have been wronged by a larger company. They're not in the Mass Tort business, but to your point before, Mike, you want to talk about something ethical, go watch that. It was on July 23rd, I think. There's a 12-minute segment on it. Very powerful. A farm owner for years that ran habanero peppers was affected because he had one client. It was, I think, Quay Foods that made a sriracha sauce. Basically funded his family's needs for generations. And then one day they woke up and they said, we don't need you anymore, and devastated the entire farm. Wow. He sued them Won, and what did they do? We're going to appeal. So it basically thinking that we can put this guy under and there's nothing he's going to be able to do about it. Step in litigation financing, like these folks out in California. Really powerful stuff. This stuff didn't exist 2 years ago. It just didn't. It was still hedge funds. It was still banking. So this is changing and evolving on a almost daily basis. When you talk about the new innovative ideas out there, the Medicare company that I told you about that's focusing just on Medicare, they're very new, but they're very good at what they do. Like there's a lot going on out there that now the public is going to have access to, which for me is exciting because it keeps my day completely different every single day, as you can imagine. One day I'm talking about Johnson & Johnson. The next day I'm talking on IRA about the history of litigation finance. I've got to keep myself in tune with what's going on in the mass tort industry. I'll end with this on this question, Mike, is a little trivia. The largest mass tort case just settled in August, largest ever settlement for America, and it was with 3M for $6 billion. Big award, obviously. The court case revolved around earplugs. 3M made some earplugs. They, based on the court case, knew that they were going to still give hearing loss to people that used it, but they went forth with it anyway. So that court case went on, as you know, for a little while, just settled in August for $6 billion. 260,000 claimants were in that mass tort case. So this is changing on almost a daily basis.
That's crazy. That reminds me of the Ford, they had the exploding cars.
Yep. Yeah, absolutely.
I think we studied that back in high school or something.
Yeah, absolutely. You're absolutely right. You're absolutely right.
Yeah, so what's the size of the market from your guys' perspective? What you focus on, and kind of how is that being out? Because there's probably a lot of different things you have to focus on. There's a lot of data you have to go through.
Yeah.
How big is the team? How do you kind of extrapolate?
You're absolutely right, Skylar. Yeah. So tough to do at times, as you can imagine, because when you're talking about a law industry where no lawyers like to share their secrets with anybody else, it makes it a little bit difficult to navigate that. The way that we typically look at it is we will say, okay, if there's 12 mass tort cases going on in America on any given day, there is absolutely a number attached to those, a ballpark, if you will. For instance, Johnson & Johnson, $9 billion. Will it settle at $9 billion? I don't know. It could be 11, it could be 7, but there's a general ballpark for that. So the industry as a whole, from an awards perspective, is quite large. It's quite large. If we've got 12 going on at any given time and 6 of them are in late stage finance, those are the 6 we're looking at. And what I mean by 12 going on at any time is 12 that are very substantial cases, hundreds of millions, if not billions. The smaller mass tort cases that go on, they're not advantageous for our clients, at least, where we're not looking to get into a smaller deal that somebody may be awarded $7 million. It's just not worth it for our clients to do that. We want the bigger ones because those are where you're going to find your clients. Remember 3M, 260,000 different people were affected by that.
Right.
There's a lot of space to be able to help a lot of people, but it also means that if I equate it to a market cap perspective, the market cap is quite large where you're playing in a big old sandbox, if you will. When it comes to mass tort litigation.
Wow. Interesting. Yeah. From the RIA perspective, I know there's certain, things that they focus on and requirements, right, that they look at. Is that any specific items that they kind of have questions about, just kind of go through their iterative education, operational due diligence process?
Yeah, absolutely. The largest single question that comes up, and I think it comes up for every single person that's got a product out there, is show me a track record. What have you done in the past? So, the interesting part about what we're doing is not only is it exciting because it's new, but because it's new, there's no track record. So that seems to be the one part where an RIA and advisor will say, how do I get around the idea of there not being a track record for this specific product? The way that I explain that is, show me any mass tort case that has gone post-bellwether, and I'll show you the concept actually rings true. Show me 3M, who went post-bellwether and had to settle for $6 billion. Our concept, our structure, if you will, works because of the way that we're investing. We're investing in that post-bellwether. Still trying to find that one, as I told you, still trying to find that one that's gone post-bellwether that did not rule in favor of the plaintiff. Not that it can't happen. It can, obviously. But when you look at a mass tort case, that's the way that I like to portray it to the RIAs is let's step aside from Valiant for a second and let's talk about mass tort law because that's what you're invested in. You're invested in that mass tort law. We just happen to go to the post-bellwether side.
Yeah.
Does that make sense?
Absolutely. Yeah. Sounds like you have a lot of things being thrown at you at all once on a daily basis.
Every day.
Never a dull
Every day.
Kind of bringing this to, kind of crypto is one thing that like comes to mind where, when I see these crypto exchanges, like Coinbase used to charge 2%, to make a trade, now it's down to, I don't know, 0.4, 0.5%, per trade. Do you see, I guess, how do you see the future of kind of margins in the industry? Do you see it, kind of consolidating over time?
Very, very good question. The minute that a lawyer starts charging less, which is never going to happen, is the minute that these margins will come down. Now, the specific reason why we're able to offer that 15% return, as you can imagine, is because we're going after these mass tort cases, not only post-bellwether, but obviously large, affecting a tremendous amount of people, and the awards are going to be great. With that, you can imagine that as long as we pick the right court cases, you're not going to see those margins start to compress at all. I have yet to meet a lawyer yet that has said, you know what, I don't need 40%, just give me 10%. When that happens, okay, then maybe we've got to start compressing a little bit. I just don't see it happening.
Yeah, makes sense.
Cool. Anything else on your end, Skylar?
No, it's just, it's an interesting, thought process. And the fact you guys have focused on a very narrow niche in this large opportunity in this marketplace. And the fact that, last 2 years, it's really come to fruition, which is pretty amazing where it's at today.
Yeah. To your point, Skylar, I mean, I think at least my humble opinion, the ability to be successful in any sort of investing is to understand exactly what you're doing and be hyper laser focused on that. There's a lot that gets in the way. To our point of talking about Bigfoot before, essentially we know he's a mythical creature. We've just got to stay grounded and stick to our knitting, know what we do it well, and be able to deliver those returns for our clients.
I love it. Bringing it back full circle, Sean.
I've gotta.
This has been great. Thank you so much. Where could people go to connect with you and learn more about Valiant?
Sure, absolutely. It's valiantfinance.net. You can just pop on there. It'll show you the Valiant family of funds for our next magic trick. Maybe you guys will have me back at some point in the future. We'll have a second product coming out that's right in your wheelhouse, Mike, which is revolving around digital money. Again, a secured note. Nice. So we'd love to come back and talk about that. But yes, you can check us out on valiantfinance.net. You'll see my ugly mug up there as well, and you can meet the whole team there. Reach out to us right on there. I'd be happy to help you guys out.
Awesome. Thanks for the time, Sean. We appreciate it.
No, thank you, guys. It was a pleasure.
We hope you enjoyed this conversation. Please make sure to like and subscribe for more content like this. And if you're interested in starting a fund, whether it's a hedge fund, VC fund, whatever type of fund you're thinking, please reach out and let us know if there's any topics that you'd like for us to cover. Thanks for watching.